So everyone keeps having the same question. If mortgage rates are finally coming down, why doesn't it feel like housing is any cheaper? Interest rates have stopped rising, monthly payments are lower than they were last year, and affordability, at least on paper, is improving. So logically, you'd expect prices to fall. But according to Zillow's latest housing market data, that's not what happened. Home prices didn't crash last year. They didn't even fall in most places. They simply stalled. And that matters more than almost anyone else realizes, because it tells us something uncomfortable about the housing market, something that explains why policy ideas, rate cuts, and even improved affordability haven't produced the reset people keep waiting for. So in this video, I'm going to walk through Zillow's December market report, what the numbers actually show, and why a market where prices stop rising is very different from a market where prices fall. By the end, you'll understand exactly why housing feels stuck, why 2026 is unlikely to deliver the relief many buyers are hoping for, and what actually needs to change before affordability becomes more than just a headline. So let's talk about the big picture. As of December 2025, the housing market is not crashing. It's not booming either. It's simply stabilizing. Home prices have largely flattened, mortgage payments have come down, and affordability is slowly improving. But inventory remains tight, and that tension is shaping everything. See, Zillow's most recent data shows a market that is cooling in motion, but still constrained at its core. Let's start with home prices. In December 2025, the typical US home value sat at about $359,000. That number hasn't moved much month to month. In fact, across the 50 largest metro areas in the country, none saw meaningful monthly price growth in December. Some markets, like Austin and parts of the Sun Belt, saw modest declines, but others like New York and San Francisco were essentially flat. So this matters because it tells us something important. The market has lost momentum, but it has not lost support. Prices aren't rising, but they're also not falling. That's a very different environment from 2008 and very different from the pandemic boom. A lot of people look at flat prices and they assume that declines are coming next. But Zillow's data suggests otherwise. In fact, the main reason prices aren't falling sharply is simple. There still aren't enough homes for sale. Even with demand cooling, inventory remains historically tight. And as long as supply stays constrained, prices tend to stall, not collapse. And this is the defining feature of the current housing market. Now, let's talk about the biggest change in 2025, affordability. According to Zillow, the typical monthly mortgage payment is down over 5% compared to last year. That's not because home prices crashed, it's a combination of things. Modest price softening, slower competition, and slightly lower mortgage rates. Those have reduced monthly costs the most. In fact, monthly mortgage payments are now dramatically lower than their 2023 peak. This is the first sustained affordability improvement buyers have seen in years, and it's not just theoretical. Zillow is now projecting that by the end of 2026, 20 of the 50 largest US metro areas could be considered affordable again. And what that simply means is that their housing costs fall below 30% of the median household income. That would be the most affordable metros we've seen since 2022. But here's the part that most headlines actually leave out. Affordability is improving without prices crashing. That means this is not a buyer's market in the traditional sense. It's not driven by distressed sellers or excess supply. It's simply driven by stabilization, which also means this improvement can reverse if rates rise again or if inventory tightens further. And speaking of inventory, that's the biggest constraint in the market. Zillow's data shows that new listings dropped sharply toward the end of 2025. Many sellers simply stepped back and took their homes off the market or decided not to list them at all. Why? Because millions of homeowners are still locked in to ultra-low mortgage rates from 2020 and 2021. Selling simply means giving that up. So instead of listing, many homeowners are staying put, and this keeps the total housing supply low, even as demand cools. So that's why prices aren't falling the way that many people expected. Now let's talk about sales activity. That has improved slightly. Existing home sales ticked up on a seasonally adjusted basis at the end of 2025. But let's be clear, we're still operating well below pre-pandemic norms. But what's interesting is buyer's intent. Zillow's surveys show that around 1 in 5 adults say they plan to buy a home within the next year. That's a much higher number than actual transaction volume. In other words, demand hasn't disappeared. It's there, waiting on the sidelines. But those buyers are waiting for lower rates, they're waiting for clarity, and waiting for confidence in the market. And now, one of the most important takeaways from Zillow's report is how uneven the housing market has become. Some areas are holding up better than others. Parts of the Northeast and Midwest, cities like Hartford, Connecticut, Buffalo, Cleveland, continue to see relatively strong demand and stable prices. Meanwhile, some previously red-hot markets like Austin, Phoenix, and parts of Florida are experiencing more noticeable softening. This isn't a national crash. It's simply a regional rebalancing. And that means national headlines are becoming less useful. Local data is starting to matter more than ever before. So, from this report, what does Zillow expect to happen next? For 2026, Zillow forecasts modest national home price growth, roughly 1 to 2%. Not a boom, not a bust. A slow, grinding normalization. They also expect slightly higher sales volume, continued improvement in affordability, and more markets becoming accessible to median income buyers. But again, this is not driven by a flood of new supply. It's driven by gradual adjustment. So if you're a buyer, here's what the reality is for you. You have more breathing room than you did 2 years ago. Monthly payments are lower, competition is less frantic, and price cuts are a little more common. But inventory is still really tight, which means the best homes in the best areas are still moving quickly. Timing the market perfectly is less important than understanding your local conditions. Now, if you're a seller, the days of naming your price are also over, but the market is still working in your favor if you price correctly. Homes that are priced realistically are still selling. Homes that chase yesterday's prices are sitting. This is a market that rewards strategy, not optimism. So here's the real headline from Zillow's report. The housing market didn't break, it simply adjusted. Prices stopped rising, affordability improved, and inventory stayed tight. And 2026 just looks like a continuation of that slow recalibration, not a dramatic reset or crash. If you're waiting for a crash, the data doesn't support it. If you're waiting for a perfect moment, it may never come. But if you're paying attention to how this market is actually changing, you're already ahead of most people.